Welcome back for segment number two of financial management for small business owners. I'm Maggie Longest, Executive Director of Downtown Ashland Association, and with me is Eric Glymph, President of Edge Business Planning. And he is going to talk to us about cash is king for every small business owner. Go ahead, Eric.
Okay, thanks, Maggie. Well, let's jump right in. So we talked about the importance of understanding your financial statements in number one, and now we're going to talk about the importance of cash. Cash is king, especially for a newly founded business or in a growing business. So let's talk a little bit about some of the things that I've seen over the years with the clients I work with, and my own personal experience about some of the things that may cause cash flow problems. So you might have, there's a list here, and let's run through them. One is difficulty in collecting receivables. So this one's interesting. I've talked to many business owners, and they've been, their business is going great. They're really selling like crazy, but they're like, I don't have any money in my bank account. And I'm like, well, have you sent out invoices? And they're like, oh, well, I haven't had time to do that yet. I'm like, oh, that's not good. Or they've, they said, I've sent out invoices, but, nobody's paid me yet. I haven't had time to collect or call people because I'm so busy. Well, that's a challenge as well. So you want to be able to put systems in place that make it easy for people to pay you. I know I have discussions sometimes with people like, I don't want to pay credit card fees. Credit card fees, it's 2.5, 2.83% of your fee. And I understand that. However, if you're spending more time chasing people down, trying to collect, and it takes you 2 or 3 months to collect somebody, and you have to make a bunch of phone calls and emails, it might be easier just for them to pay you one time via credit card, and you'll probably end up saving money from that perspective. So you want to have your systems in place. There are great accounting systems out there. I know a lot of people use QuickBooks as an accounting system that sends out invoices automatically, allows people to click on a button and pay now, makes it very seamless. So you want to definitely look at that as an opportunity there. The next is seasonality of sales. So many businesses have, their businesses, the fourth quarter of the year is when they sell a whole bunch and they get a lot of cash in then, and they're super excited and happy. And then the first quarter comes along and the cash flow is much, much less. So there's that seasonality, and we'll talk about forecasting in the next section, but you want to understand where your cash is coming from, throughout the year. So you're able to adjust for, not get too excited when you have a whole bunch of cash in the door, knowing that next quarter might be a little slower. So you can make sure you manage that closely. The next one's unexpected variations in sales. So this is one that, recently when we're recording this, we're on it's been almost a year now that we've been in the COVID environment. And obviously when that hit last year in March of 2020, that it was a significant impact to a lot of businesses. I used to use the analogy of a hurricane. This is like a year-long hurricane, really, is what we're in right now. So you've got that, those things that pop up that you don't really plan for, but those things do happen. And hopefully they're a shorter-term impact, but those things can impact your business, and you want to make sure to, those are things that can be a problem as well. How you pay suppliers. You may make sure that you want to make sure that you are paying your suppliers, your key suppliers, on time. You want to understand who are your key suppliers. Who are those people that if I don't pay these people, it's going to severely impact my business. So you want to be able to categorize your suppliers and know who are the most important, and also see if any of them are providing you with any sort of incentive. Sometimes they may say, hey, if you pay early, we'll give you a 2% discount or a 3% discount if you pay within 10 or 15 days. So make sure you understand that as well. Large expenditures on upfront for customer projects. I like to call this the Walmart effect. I worked with some high growth startups, and they're like, we want to get into Walmart. We've got to get into Walmart. And then they're able to, and they get into Walmart, and that's great. And then Walmart says, okay, we need $150,000 of your product in our stores in the next 60 days. And you're like, oh, okay, I've got to be able to come up with the cash to create that, all those products or services and get them to Walmart. And then Walmart will say, great, we'll pay you in 90 or 180 days, right? They're notorious for slow paying. So you've got this big gap in cash. You need to come up with a bunch of cash up front that you're not going to get paid on until later. So, understanding that definitely can put people into a cash crunch as well. Capital projects, if you need to make an investment in your business, maybe you need to upgrade a building or even open a new location, those type of things can take up some cash flow as well. And the last one I see a lot is inventory management, ineffective inventory management. So these are ones where, if you have a lot of inventory that's not, and you're not managing well and you're not turning it over and it's not selling quickly, that's just cash tied up, sitting on a shelf, hopefully not collecting dust. But you want to be able to, I've seen that a lot with clients I've talked to where, they're like, I don't know where my cash is. And then you look at your inventory and they've got $100,000 in inventory, which is like 3 or 4 months worth of inventory. And that's just cash just sitting there, not being useful to you. So that's another area that's a key area for people to focus on. Okay, so let's talk about cash flow keys to survival. One is know your break-even point. I'm going to go into that more in a minute on the next slide, so we'll hold that one, but that one's a key one to know what your break-even point is. Manage your customer receivables. So again, this is like we talked about earlier, have a system to collect, make sure you stay on top of it. Most accounting systems like QuickBooks and others have a report you can run. It's called an AR aging report or an accounts receivable aging report, and it'll show you your customers by customer. Are they current? Are they 30 days past due? Are they 60 days past due? Are they 90 days past due? So you want to make sure to look at that and know where your customers are and make sure they don't. If anybody's past 30 days or 60 days for sure, you want to make sure you're reaching out to them. My experience has been, there's some customers who are kind of jerks and don't want to pay, but most of them just, they'll pay, they just forget, and if you send them a reminder, they're like, oh yeah, I forgot, and they pay you. But if you don't remind them, then they forget about it too. So manage your vendor payables. We talked about that a little bit, making sure that your vendors are paid. Prioritize who you're paying. And if for some reason you can't pay a vendor, make sure to have a conversation with them and let them know that, hey, I'm having some problems paying you, and let them know. And usually they'll work with you on that. My experience has been that if you don't reach out to them and just ignore them, that it ends up making the situation worse. So it's better just to be upfront and say, you're challenged paying them right now. If you can pay part of it or work out a payment plan is a better option. Manage your expenses closely. So that's reviewing your profit and loss statement, especially in your cash, making sure you understand your expenses, because a lot of times those small expenses can add up pretty quickly. You're spending $50, $100, $500 here, and next thing you know, you spent $5,000 or $10,000 that you didn't know about. So you want to make sure to look at those, all your expenses closely, maybe at least every couple months or quarterly, to make sure you're understanding where your expenses are going. The last two I kind of put together: monitor cash flow frequently and have a system to review. You want to make sure that your cash flow, that you look at it fairly often. If you're tight on cash flow, you might be looking at it every day. If it's a little bit more, you're a little bit in a better position, maybe it's every couple weeks or once a month, but you want to be able to monitor that. And people ask me what the best system is, and my answer is whatever system works best for you. There are some very sophisticated cloud-based cash flow systems that connect into QuickBooks, which are great, but if you're not going to use it, if it doesn't work for you, then if what works for you is a pen and a piece of paper or a bank statement or whatever you need to be able to understand where your cash is and where cash is coming in and going out, that's the system for you to use. All right, let's jump to the next slide, which is break-even analysis. So there's a couple charts here and or a chart here and some other things. So break-even analysis is really about understanding how much do you have to sell to cover your fixed cost. So what are fixed costs? Fixed costs are things that, think about it of, if I don't sell one thing at all tomorrow or next month, what things do I still have to pay for? Most people, you have rent, you have utilities, you may have some debt payments. Usually payroll, I say payroll is a fixed cost, especially if you're paying people on a salary. If you have some variable costs where you pay somebody like hourly rate based on what they make or what they produce, then that's a variable cost. We'll talk about that in a minute. But even if you pay somebody hourly, and say you own a restaurant, and you're saying, in order to keep the doors open, even if nobody comes in and buys anything, I have to have one person in the building. Well, that's a fixed cost, right? You got to pay that person to be there. So determine what those fixed costs are, and that's the line that's shown right here. That's your fixed cost. That's going to be a flat amount. In the example we're going to use, that's going to be $20,000. Their fixed costs are $20,000. And then you want to determine, the next part is, what are your variable costs? So what are those things that for every unit you sell or service you provide, this can be a service as well, what are the raw materials, like whatever product cost information you have or product cost you have. Maybe you pay somebody commissions, or you have specific direct labor, those type of things. So those are all variable costs. So for every unit you sell or service you provide, there's going to be that additional cost. So let's go through an example here down at the bottom in this blue box here. So in this example, we've got product sales. So we sell a product, it's $50 a unit. Our variable costs in this case are $30 a unit. So I'm going to say we're paying somebody commissions. So we have a service we're providing, and we provide it for $50 per service, and we pay somebody $30 in commission for every $50 sale. So we're making $20 on each unit, and we have fixed costs that are $20,000. So how do we figure out our break even? We have $50 here, less $30 per unit. So we're making $20 per unit. That's what we call our contribution margin. So that is what helps cover our fixed costs. So for every one unit we sell, we get basically a net $20. So we have $20,000 in fixed costs divided by $20 per unit. That means we have to sell 1,000 units, or 1,000 services need to be sold to cover our fixed costs. So if we take 1,000 units times $50, that's $50,000 in sales we have to do. So think about it this way: you have $50,000 in sales, less $30,000 in variable costs. That's like commissions we're paying, gives you $20,000, and that's our fixed cost. Our fixed costs are $20,000, so our net is zero. That's our break-even number, our break-even point. So in this way, you can look at how many, when I say units, that could be a product or it could be a service that you provide, times the sales price to get, and look at that to get your break-even.
So it appears that this is the kind of analysis that's been very helpful to small business owners in 2020, as we've all been adjusting to a pandemic. So that doing a break-even analysis is a small business owner's way to identify what they have to, the minimum they have to make, right, to stay in the black, to not have to dip into savings or their loan. And you've done a great job of explaining that it's what they have to make in profit, in net, what they have to net every day or every month. And so to figure out how much sales they have to make, you're adding that additional sales revenue, right?
Right. Yeah. Yeah. So the first step is always figuring out what are those fixed costs. So that's the baseline. You have to sell just to keep going and keep at least break even and not losing money.
Right. And so then everything above that $50,000 point, for instance, is gravy. Is where you're actually starting to make a profit.
You're starting to make that profit. That's right.
Thank you.